You're watching the news at 1. Thanks for staying with us. If you just joined us, thanks for joining us. Let's take a look at your market news now. Asian stocks saw mixed performances, with Japanese stocks retreating and Hong Kong shares striking highs. Resource shares suffered on the back of a slide in oil and commodity prices. Japanese stocks took a hit today as mining, oil and shipping stocks lost ground, with Bitcoin-related stocks tumbling after the cryptocurrency's value extended sharp declines. The Nikkei share average fell 0.4%. Hong Kong stocks continued their rally, hitting yet another all-time high at market close. The Hang Seng Index rose 0.25%. Chinese equities saw mixed performance, with gains in banking and infrastructure, but these were offset by declines in consumer and real estate shares. The Shanghai Composite Index closed up 0.26%. Wall Street stocks started yesterday's session with good gains, with the Dow Jones Industrial Average breaching the 26,000-point level for the first time, and the S&P touching 2,800 points. However, the initial burst of bullishness faded despite good fourth-quarter earnings reports. The Dow Jones Industrial Average edged down 0.04%. The S&P 500 lost 0.35%, and the tech-heavy Nasdaq Composite Index declined by 0.51%. Let's get some more news on the markets now. We're going to cross to the Johannesburg Stock Exchange. Nompumelelo Siziba is standing by. Nompumelelo, over to you.
Well, the all-share index has been trading in positive territory today, and that goes against what's been happening in Europe, where we've seen some declines on the bourses there. The local currency has weakened against the US dollar, and this may be part of the reason why we're seeing support with South African equities, particularly your rand hedges, which get a lot of their income from overseas. And so therefore, when translated back into rand, they have better revenues because of the weaker currency. And the US has generally ticked up against, the US dollar, has generally ticked up against other currencies. And we've seen commodity prices suffer as a result, because many of them, or the vast majority, are denominated in the US dollar. And so when the value of the dollar rises, those commodities become more expensive and less attractive to people who are holding currency that's different to the US dollar. Let's take a look at the indicators. Well, I'm joined by Michael Trehan. He's a portfolio manager at Vestax. Thanks for joining us, as always, sir.
Number, great to be here. 2018, let's hope it's a good year.
Indeed, let's hope so. Markets looking somewhat mixed today, but the trend generally weaker to what we've seen earlier in the week. What do you see as the key drivers today?
Yeah, look, I think markets yesterday, both S&P and the Dow Jones broke new territory. Dow Jones breaking 26,000 for the first time, and S&P breaking 2,800 for the first time. So general uptick. Towards the end of the day, US markets did fall back, though, because Friday is D-Day in terms of funding for the US government. If the Republicans and the Democrats haven't sat down and signed a bill to increase the US debt ceiling, the federal government's going to run out of money. So slight concerns around that, and that's why we saw the US market pull back towards the end of the day. But that doesn't look like it's going to be a problem come Friday. Both sides of the aisle saying that they are going to reach an agreement, and the US will carry on as normal.
Well, I was going to say it feels like Groundhog Day, whereby, you know, we've been here before, we've had this conversation before. Will they or will they not resolve the issue? And they always do, don't they? Because they can't afford to not to.
Yeah, it's a big game of chicken at the moment. The Democrats throw a few of their requirements before they'll sign, and the Republicans throw in their requirements before they'll sign, and then it's all about who blinks first and who's willing to give up the most. But at the end of the day, both sides can't afford for the US government to shut down. That's just disastrous all over. So they will come to an agreement, and it might be that they just kick the can down the road for 1 or 2 months, or they might sign a big, long-lasting agreement and then potentially kick it down the road for longer than 12 months, hopefully.
Okay. Now, we've seen that tech stocks, or at least so there were some financial results that came out yesterday. One particular Dutch company that sells chips came up with much better than expected results, which suggests that we're going to see very good results from the tech sector. And I know you're somewhat of a fan. Does this merely support the all-time highs that we've been seeing coming from the tech counters?
Yeah, so it's the underlying profits obviously are what's driving share prices higher, and the profits have been coming through strong and stronger than expected, which is what's pushing the markets up even further. And as a society, as a global population, as we move towards the internet, towards technology to make our lives better, there's still a lot of runway to come. If you have a look at the areas where it's concentrated, it's mostly the developed world, with the developing world catching up, and the developing world is catching up very quickly. Having said that, there's still only 50% of the globe has access to internet. So imagine what happens when the other 50% start getting access to internet. So I think your very long-term story is still intact for tech, and if you hold it, just keep your head down. There will be tumultuous water coming up ahead at some point, but it's worth the ride, I reckon.
Now, as I mentioned to the viewers, we're seeing a slightly stronger dollar today, and that would be negative generally for commodities. Is that what we're seeing today?
Yeah, generally there's an inverse relationship between the dollar and commodity prices. Dollar bouncing off 3-year lows. At the moment, there seems to be a cyclical shift from investing in the US and starting to invest in Europe. Europe's now growing at over 2.5%, which they haven't done since the financial crisis. So it looks like Europe's growth is back on track. The Greece issues look like they'll be done by the end of this year. So Europe looks to be the place where people want to invest. You rewind 3 years ago, US was where everyone wanted to invest, and they couldn't get US dollars quick enough, and that might have been overdone a bit. The US dollar is now weakened for the last 6 months or so, and it's just a bit of a bounce off weak levels.
So now, with global economic growth seemingly looking better for this year, does that mean it's better for commodities fundamentally?
Generally, yes. The thing is, a lot of the commodities through technology are becoming obsolete or being used a lot less. So it's that constant tussle between are you going to use more of them, or does technology replace you? And then on the flip side, you have a look at the technology coming into the production side of things. You have a look at your major global miners, the cost of getting iron ore out of the ground, for instance, and how those numbers have significantly gone down over the last decade. So as it gets cheaper and cheaper for them to get out of the ground, obviously your supply is going to increase, and if your demand doesn't keep up with the supply, that's going to push down the price. So it's always a demand and supply battle, but as long as demand is higher than forecast, generally you see prices going higher until things stabilize again.
And then here at home, big expectations from the market around the Reserve Bank. Seemingly the consensus, or generally people feel that the Reserve Bank won't move on rates. They'll wait a while. But there are about 5 economists on the Reuters barometer who have said that they believe there may be a rate cut. What's your belief? And is that part of the reason why we're seeing the rand weaker, or is that just a dollar story? 2 questions there.
Yeah, so look, I mean, currency is a general, a volatile thing, and it's a very slight tweaks in supply and demand will impact the currency by 10, 20 cents here or there. So we've been in a solid range for the last week or so, so it's normal market mechanism, so I wouldn't look too much at the currency. As far as the Reserve Bank goes, I think it's still too soon to start the cutting cycle again. You'll remember we informally in actually a raising cycle, but we're talking off air, the retail sales numbers up 8.5%, which is great to see, and that just shows strength again on the ground, which means the consumer could potentially handle, or our economy is growing, so we can handle a rate cut. But I think it's still too soon to handle a rate cut. Currency a lot stronger does assist that. But monetary policy, these guys are looking 12, 18 months down the line. And you don't want to be chopping and changing, going from a cutting cycle to a raising cycle, straight back to a cutting cycle within a 1 year period. So I think it's still too soon, but I think you're going to hear lots of positive sentiments coming from Lesetja Kganyago saying more than likely we'll probably see one this year, probably won't see a rate hike, and I think consumers will appreciate that.
Well, let's hope so. Thank you very much for your insights and your time, as always, Michael. Well, that was Michael Traherne giving us his insights from Vestact. After a short break, and Nzinga has more business news.